Dow Jones Industrial Average closed at 53,975.98. That is down 60.95 points, or 0.11%. S&P 500, 7,753.11 million, down 4.53 points, or 0.06%. NASDAQ Composite closed at 26,605.36.
Right.
That's down 85.26 points, or 0.32%. And the Russell 2000, 3,017.40, down 17.0 points, or 0.56%.
Yeah.
And finally, the 10-year Treasury yield closed at 4.69%, which is, easing just slightly from that intraday high of 4.73%.
Right.
So this is your fast, energetic, end-of-day recap of a market that is, frankly, currently trading in a remarkably tight consolidating range with well below normal late summer volume.
Yeah, very low volume.
Exactly. You are looking at a market that feels exactly like a car idling at a red light.
Oh, that's a great way to put it.
I mean, the engine is revving, right? The RPMs are up, the noise is deafening, but the tires just aren't moving forward.
They're just spinning.
Exactly.
Yeah.
And when you look under the hood at the negative market breadth today, which, by the way, is a crucial metric we need to talk about, with NYSE decliners beating advancers 1.39 to 1, and the NASDAQ decliners leading 1.47 to 1, you really have to ask yourself, is the engine actually stalling out?
Right.
Or are we just, waiting to drop the transmission into gear?
Well, I mean, it is definitely not stalling, but I do love that analogy because it perfectly captures the anxiety of a late summer market.
Yeah.
The transmission is stuck in neutral, right? The driver's foot is just hovering over the gas pedal, and we are all staring at a red light that simply hasn't changed yet.
Just waiting for the green.
Exactly. And the reason for that anxiety is that the market right now is entirely captive to external catalysts.
Right.
When we look at those breadth numbers you just mentioned, the 1.39 to 1 ratio on the New York Stock Exchange, that tells us a very specific story. It means that for every one stock that went up today, nearly 1.5 went down.
Right, which isn't great.
No, it tells us that the broader participation, like the actual foundational health of the market beneath the surface of those mega-cap tech stocks, is weak today. And the most immediate, overwhelming pressure driving that weakness came straight from the energy markets and geopolitical headlines.
Right. So let's dive straight into that macro catalyst, because it really is the biggest shadow hanging over the trading desks right now.
Huge shadow.
WTI crude oil rose 45 cents today. That's an increase of 0.55%, bringing it to $82.59 a barrel.
Yep.
Now, on the surface, 45 cents might not sound like a market-shattering move to you. People might think, okay, gas is going to be a fraction of a penny more expensive, big deal.
Right, a rounding error.
Exactly. But this fluctuation isn't about traditional supply and demand mechanics. It's not about, someone driving more or a refinery going offline for standard maintenance.
No, not at all.
It is tied directly to the ongoing Iran war and the closure of the Strait of Hormuz.
Yeah, that's the real issue.
And we're seeing reports indicating that Qatari and Pakistani authorities are signaling some optimism for a U.S.-Iran deal that could finally reopen the strait.
Which would be massive.
It would. But I want to be very precise about how complex this geopolitical chessboard is right now. We are just impartially reporting the facts as they are stated by the involved parties.
Right, just the facts.
The Trump administration has made it clear they want to end the war before November. However, they have directed their representatives to demand financial compensation from Iran for damages incurred during the conflict.
Which is a huge sticking point.
It is. That specific demand obviously complicates the negotiations heavily. On the other side of the table, Iran has explicitly threatened to hit energy infrastructure in the UAE, Kuwait, Qatar, Bahrain, and Saudi Arabia if their own power plants are attacked.
Yeah.
So I look at all of this and I have to wonder, how exactly does a geopolitical standoff thousands of miles away dictate whether my portfolio goes up and down on a Tuesday in August?
Well, it dictates it because of the concept of the geopolitical risk premium and really the very specific geography of the Strait of Hormuz.
Okay.
Let's break down why that specific body of water matters so much.
Please do.
The Strait of Hormuz is essentially a narrow aquatic highway connecting the Persian Gulf to the Gulf of Oman and the open ocean.
Right.
A massive percentage of the world's liquid petroleum passes through that single choke point.
Just that one spot.
Exactly. So when you have explicit threats of widespread infrastructure attacks, not just on one nation, but across the entire Persian Gulf, I mean, UAE, Kuwait, Qatar, Bahrain, Saudi Arabia, you are threatening the global cardiovascular system of energy.
So it's literally like someone threatening to pinch the main artery to the heart.
Exactly. And when that threat exists, commodities traders, they don't wait for the rockets to actually fly.
They price it in immediately.
Right, they price in the probability of the worst-case scenario. That is what a risk premium is.
Okay.
That 45-cent bump you mentioned today, that's a mathematical representation of fear.
Right.
But to answer your question about why it impacts a tech portfolio in New York,
Mm-hmm.
energy is the foundational input cost of the entire global economy.
Yeah, it touches everything.
It does.
Ah.
It's the cost of shipping the servers, it's the cost of running the manufacturing plants, it's the cost of cooling the massive data centers. When oil prices swing upward, it instantly revives inflation concerns.
Because every single company in the S&P 500 suddenly has to pay more just to operate their basic logistics.
Precisely. And for equities, that acts as an absolute wet blanket.
Yeah.
Higher oil means higher transportation costs, higher manufacturing costs, and ultimately a higher consumer price index.
Right.
The stock market is essentially a forward-looking discounting machine. It looks at future profits and discounts them back to today's value.
But it can't do that if the inputs are unknown.
Exactly. It can't confidently buy into a sustained equity rally when the most basic variable, the cost of energy, is held hostage by a geopolitical stalemate.
Wow, yeah.
If inflation spikes because of oil, the Federal Reserve might have to raise interest rates, which crushes stock valuations.
Right.
It is a direct causal chain from the Strait of Hormuz right to the valuation of a software company in Silicon Valley.
Man, let's follow that exact chain, actually, because if energy prices are threatening to drive up the consumer price index globally, I want to know what is actually happening on the ground here domestically.
Let's look at it.
We got the July NFIB Small Business Optimism Index today, and the headline number is actually pretty striking.
It really is.
It rose 2.4 points to 99.8.
Yeah.
That is its highest level since August 2025, and it finally sits above the 52-year average of 98.0.
Yeah, a solid jump.
Okay, let's unpack this, because I need you to help me untangle a massive contradiction in this data.
Sure.
The hiring plans absolutely surged. A net 20% of small business owners plan to create new jobs over the coming months.
Right.
That is up 9 points, and it's the highest reading we've seen since October 2022, so they clearly want to hire.
They do.
But then, in the exact same report, 36% of owners reported having job openings they simply cannot fill.
Yeah.
That's the highest since June 2025. Furthermore, 27% explicitly cite labor quality and availability as their #1 top-tier problem.
Huge issue.
To put that in context, the historical average for that specific complaint is 12%. It has more than doubled.
Crazy.
So I'm looking at this and thinking, this sounds like pure madness. How can small businesses plan to hire at record rates when they are simultaneously screaming from the rooftops that there are 0 qualified workers available to fill the jobs they already have posted?
Right.
Is this just blind, irrational optimism?
It is a fantastic question, and it highlights one of the most bizarre economic environments we've ever studied.
It really is bizarre.
But it is not blind optimism.
Yep.
It is a reflection of a deeply constrained, paradoxically strong, real economy.
Okay.
Think back to the car idling analogy you used earlier.
Yeah.
The desire to expand, which we also see confirmed in the capital expenditure numbers, where 25% of these businesses plan to make major capital outlays in the next 6 months.
Which is the highest since December 2024, yeah.
Exactly. That desire shows that the underlying consumer demand is still there.
People are still buying things.
Right. Businesses want to grow. They are revving the engine.
Yeah.
They have the financial capital to build a new factory or open a new storefront.
But they literally can't find anyone to run the cash register or operate the forklift.
Exactly. The structural labor deficit is the parking brake.
Wow.
And it's structural because it's not just a temporary mismatch. We are looking at long-term demographic shifts. The retirement of the baby boomers, shifts in immigration policy over the last half decade,
Yeah.
and a profound skills gap where the people looking for work just do not have the specific training for the jobs that are open.
Right.
So businesses are signaling that if the labor magically appeared tomorrow, they have the demand to justify hiring them instantly. That's the 20% planning to create jobs.
I see.
But the reality of the labor pool is the 36% who have openings gathering dust.
Okay, let's pause on that for a second, because if you can't find workers, you usually have to pay higher wages to attract them, right?
Naturally.
And higher wages usually mean the business has to raise the prices of their goods to protect their profit margins.
Right.
But the inflation data in this NFIB report tells a completely different story.
Yes, and that is the most critical takeaway for the entire macroeconomic inflation narrative.
Right, because only 14% of the small business owners cited inflation as their top problem. That is down 7 points from the previous survey.
Huge drought.
And the net percent of owners actually raising their current selling prices dropped to 31%.
Yeah.
That comes after 4 consecutive months of steady increases. So they are complaining about labor, but they aren't raising prices as aggressively. Why the sudden hesitation?
Because the consumer elasticity is finally snapping.
Really?
Yeah. For the last 2 to 3 years, in the post-pandemic inflationary spike, businesses discovered they had almost magical pricing power.
Right. People just kept buying.
Exactly. If their supply chain costs went up 10%, they raised prices 12%, and the consumer just grumbled and paid it anyway.
Yeah, we've all been there.
Right. They passed every single cost increase directly to the end buyer. But this report suggests we have finally hit a brick wall.
Consumers are done.
They're pushing back. They are trading down to cheaper brands. They are skipping the extra purchase. They are actively resisting price hikes.
Okay.
So what happens when a small business is facing higher wages to attract scarce labor, but they can no longer raise the price of their product without losing their customers?
I mean, they just have to eat the cost.
Precisely.
Yeah.
They're forced to absorb those costs.
Wow.
From a macroeconomic perspective, this is fantastic news for the Federal Reserve because it helps cool the broader consumer price index.
Sure, inflation comes down.
Exactly. But from an equity market perspective, it means corporate profit margins are about to get squeezed. That is a very tricky tightrope for the market to walk.
Which brings us directly to the Federal Reserve and the bond market because they're watching all of this in real time.
Absolutely.
We have cooling Main Street inflation, at least in terms of price hikes colliding head-on with these global oil price spikes we just talked about.
Yeah, it's a mess.
Let's look at the current numbers. The Fed's target range remains at 3.5% to 3.75%. But because of that oil price spike acting as an inflation threat, the market pricing for a September rate hike just bumped up significantly.
They did.
The futures market is pricing in roughly a 52% probability of a hike, up from 44% just last week.
Big jump.
We even had Cleveland Fed President Beth Hammack go on the record stating that multiple rate increases could be necessary to actually hit and maintain their 2% inflation target.
Which spooked people.
Definitely. And you can see this tension reflected perfectly in the bond market yields today.
Oh, yeah.
The 2-year Treasury yield is sitting at 4.23%, while the 10-year Treasury yield is sitting at 4.69%.
And this is where we have to talk about yield curve dynamics.
Yeah.
Because the bond market is essentially the nervous system of the global financial system.
Yeah.
And it is twitching violently right now.
Right.
Let's define exactly what we are looking at.
Huh.
The yield curve is simply a line on a graph showing the interest rates of U.S. government bonds across different maturity lengths, from 1 month all the way out to 30 years. Normally, that curve slopes upward. If you lock your money away for 10 years, you demand a higher interest rate than if you lock it away for 2 years because there is more risk over a 10-year horizon.
That makes total sense.
Right. That is a normal, healthy economic indicator. And right now, as you noted, the 10-year is at 4.69% and the 2-year is at 4.23%.
So the 10-year is about 46 basis points higher. And just for anyone who isn't a bond trader, a basis point is just 1/100th of a percentage point, right? So 46 basis points is 0.46%.
Exactly. So we currently have a normal, positively sloped yield curve.
Okay.
But we have to look at the historical anomaly we just lived through to understand why the market is so sensitive.
Oh, right. The inversion.
Yes. Before September 2024, the yield curve was inverted for an agonizing 28 consecutive months.
That's a long time.
It's forever in bond terms. And inversion means the 2-year yield was actually higher than the 10-year yield.
Right.
That happens when the market expects severe near-term economic distress and aggressive Fed intervention. It is the classic, undefeated predictor of recessions.
Right. Everyone always watches for that inversion.
Exactly. Living through that 28-month inversion was psychological torture for institutional investors.
I bet.
It broke models, it inverted banking profitability because banks borrow short and lend long, and it constantly signaled impending doom. We finally clawed our way back to a normal slope.
But here is what I don't quite get.
Yeah.
If the Fed looks at oil prices, panics about inflation, and decides to hike rates in September, wouldn't that just push all interest rates up equally?
No, not at all.
Why does a hike threaten the slope of the curve?
Because the Federal Reserve only controls the absolute shortest end of the curve, the overnight lending rate.
Oh, right.
When they hike, the 2-year yield, which is highly sensitive to Fed policy, shoots up almost immediately in tandem.
Okay.
But the 10-year yield is driven by long-term economic growth expectations and long-term inflation outlooks.
I see where this is going.
Right. If the Fed hikes aggressively to crush inflation, bond traders will look at that and say, okay, the Fed is going to slow the economy down so much that long-term growth will be stunted.
Yeah.
So they buy 10-year bonds for safety, which actually drives the 10-year yield down.
So the short end goes up because of the Fed, and the long end goes down because of fear. They act like a pair of scissors closing.
Exactly. The 2-year rockets up, the 10-year drops, and suddenly that 46 basis point positive slope is wiped out.
It's gone.
We plunge right back into an inverted yield curve. The bond market is terrified of going back into that inverted state, which is why the probability jumping from 44% to 52% for a September hike is causing such violent ripples beneath the surface of the stock market today.
And we absolutely saw those ripples today. The capital rotation between different sectors of the economy was violent.
Very violent.
Let's do a rapid-fire look at the sector winners and losers, and then I really want to dig into a couple of them.
Sure.
Starting with utilities, tracked by the ETF ticker XLU, they completely capitulated today, falling 1.1%. Less than 10% of utility stocks in the S&P are currently trading above their 50-day moving average, and only 29% are above their 200-day moving average.
Yeah.
In technical terms, they are heavily, heavily oversold.
Yeah.
On the exact opposite side, materials, tracked by the XLB, broke out to the upside today from a massive 6-month consolidation flag pattern of lower highs and higher lows.
Huge move there.
Energy, the XLE, rallied anywhere from 1.3% to 4.6% depending on the exact index you track, driven obviously by the geopolitical oil bounce in the sticky commodities.
Makes sense.
Healthcare rose over 1% to hit all-time highs today, led by Eli Lilly, who posted incredibly strong earnings tied to this seemingly insatiable demand for weight loss drugs.
They are on a tear.
They really are. And finally, real estate. The XLRE fell 1.2%, getting pressured heavily as monthly mortgage rates ticked up to 6.59%.
Right.
Now, I want to stop and unpack this massive divergence between utilities and materials. Because theoretically, utilities are supposed to be the safest stocks in the market, right? You buy a water company or a power grid operator when you are scared of volatility because people always need water and electricity.
Right.
So why are the defensive safe utility stocks getting completely crushed right now, while highly cyclical materials companies that sell copper and cement and chemicals are breaking out to the upside?
If we connect this to the bigger picture, to understand this rotation, you really have to look at it through the eyes of an institutional portfolio manager.
Okay.
And it all comes back to the phrase risk-free rate of return.
Ah.
You are completely right. The utilities are traditionally safe. But investors don't usually buy them for rapid price appreciation. They buy them for their dividends.
Right.
They're essentially bond proxies. A utility company might pay a very reliable 3% or 4% dividend yield every single year.
Yeah.
A few years ago, when interest rates were at zero, a 4% yield on a utility stock was incredibly attractive.
Right, because the savings account paid basically nothing, so you took a little bit of stock market risk to get that 4% payout.
Exactly. But let's look at today's environment. The 10-year Treasury yield is at 4.69%.
Yeah.
A U.S. Treasury bond is considered the ultimate risk-free asset because it is backed by the full faith and credit of the government.
You can't lose.
Right. So if I am a portfolio manager managing billions of dollars, why on earth would I take on equity risk, the risk that a utility company's stock price might drop, just to earn a 4% dividend, when I can literally loan my money to the U.S. government and get a guaranteed 4.69% return completely risk-free?
You wouldn't. The math simply doesn't make sense anymore.
It doesn't. And that realization sparks a massive institutional rotation.
Wow.
Capital flows heavily out of defensive, interest rate-sensitive sectors like utilities and real estate. Real estate suffers similarly because higher mortgage rates at 6.59% mechanically price homebuyers out of the market, crushing transaction volumes.
Okay, so I understand the money flowing out of the safe havens, but why is it flowing into materials?
Because of the economic cross-currents we talked about earlier. Remember the NFIB small business data?
Yeah, the CapEx numbers.
Right. We mentioned that 25% of those businesses are planning major capital expenditures, building new facilities, upgrading equipment.
They need stuff to build with.
Exactly. If they are doing that, they need raw materials. Furthermore, let's explain that technical jargon you mentioned, the consolidation flag pattern.
Please do.
Imagine a chart of a stock or an index. A flag pattern looks exactly like a flag on a pole.
Okay.
The pole is a sharp upward price movement, followed by the flag, which is a period where the price slowly bounces between two converging lines, making lower highs and higher lows.
Like a triangle almost.
Exactly. It means the market is taking a breath, compressing energy. When it breaks out to the upside, it means buyers have decisively overpowered sellers, and all that compressed energy is released in a new upward trend.
Wow. Okay.
Investors are looking at the sticky inflations and the geopolitical risks, and they are betting that the companies pulling raw materials out of the earth, the copper miners, the chemical producers, will have immense pricing power in a physically constrained economy.
Interesting.
They are betting on industrial expansion regardless of what the Fed does.
So while those traditional sectors, utilities, materials, real estate, are rotating back and forth based on macroeconomic winds and interest rates, there is an entirely different space that seems to be operating in its own alternate universe.
Oh, yeah.
I'm talking about AI infrastructure and the mega caps. The race for capital we are seeing in this sector is staggering, and frankly, some of the numbers being thrown around today are hard to mentally process.
They are huge.
Let's look at NVIDIA today. The stock was up 1%, closing around $217.48.
Yep.
This completely shrugs off broader market weakness, and it follows reports that they have reached a deal with major Wall Street banks to privately raise a mind-bending $500 billion to fund global AI infrastructure build-out.
$500 billion.
Yeah, $500 billion. Then, right next door, you have Intel. Intel fell 1.5% to $97.71 today, extending a previous 4% slide.
Yeah, rough day for them.
Why did they fall? Because they just announced they were raising their stock sale offering from $15 billion up to $20 billion to help fund their chip contract manufacturing business, their foundry business.
Right.
And just to round out the mega cap ecosystem, there's SpaceX. They dropped 3.88% today, closing at $133.36. Their post-IPO volatility is continuing aggressively after their very first public earnings report last week. Today, the drop was spurred by news that they are planning to offer a direct-to-cell mobile phone service to rival the big three U.S. telecom carriers.
Which is wild.
It is. It sparked wild rumors on the street that they might just try to outright acquire one of the big three, despite the obvious antitrust and regulatory hurdles that would create.
Yeah, typical Elon.
It seems like Elon Musk is actively trying to regain his trillionaire status by just dominating every telecommunications layer on Earth.
Pretty much.
But I want to focus on this NVIDIA versus Intel dynamic because this feels entirely backward to me.
Okay, let's look at it.
Please explain how the market is valuing capital here. NVIDIA announces they are taking on $500 billion in debt, and the stock goes up. Intel announces they are raising $20 billion in cash without taking on any debt at all, and they get relentlessly punished by the market.
Yeah.
Why is debt being rewarded while cash is being punished?
It is a phenomenal contradiction, and it perfectly illustrates the stark contrast in how the market treats the mechanics of debt versus equity, specifically depending on the underlying narrative and momentum of the company in question.
Okay.
Let's really dig into the mechanics of this. When NVIDIA raises $500 billion from Wall Street banks, they are taking on massive, highly leveraged debt to build out these global data centers.
Right.
Debt means they have to pay it back with interest. In an environment where the 10-year yield is almost 4.7%, that interest is going to be incredibly expensive.
Right. So why cheer for a massive interest burden?
Because of return on invested capital, or ROIC. The market views NVIDIA as the undisputed, unassailable king of AI silicon.
Yeah, they basically own the space right now.
Exactly. The assumption baked into the stock price is that if NVIDIA borrows money at, say, 7% or 8% interest, they are going to use that money to build AI infrastructure that generates a 25% or 30% return.
Oh, wow.
If you can borrow at 8% and earn 30%, you want to borrow as much money as humanly possible, as fast as possible.
Obviously.
The market cheers the debt because it views it as an aggressive, confident, necessary expansion to capture a once-in-a-generation technological gold rush.
Makes sense when you put it like that.
Now let's look at Intel. Intel isn't borrowing money from a bank. They are doing what is called a dilutive equity raise.
Right.
This means they are creating brand new shares of Intel stock out of thin air and selling them to the public for $20 billion in cash.
And since it's equity, they don't owe any interest on it. It's essentially free money for the company's balance sheet.
Yes, it's free for the company, but it is incredibly expensive for the existing shareholders.
Okay, explain that.
Think of the company's total value like a pizza. Yesterday, the Intel pizza was sliced into 100 pieces. If you owned one slice, you owned 1% of the company and 1% of its future profits.
Right.
Today, Intel decided to slice that exact same pizza into 120 pieces to raise more cash. Your single slice just got materially smaller.
I see.
You own less of the company's future profits. That is dilution.
So they're just printing shares?
Exactly.
Yeah.
But it goes deeper than just the math of the pizza slices. It is a verdict on leadership and execution.
Really?
Yeah, Intel is widely perceived by the market as playing a desperate game of catch-up in the foundry business. They're trying to build manufacturing plants to rival TSMC in Taiwan.
Right.
When they dilute shareholders to fund this catch-up, investors aren't confident that the return on invested capital will be there.
They think it's a waste of money.
Exactly. They view it as throwing good money after bad, so they punish the stock. The market loves leverage when you are winning, and it violently rejects dilution when you are struggling.
Wow. That unforgiving market behavior, punishing companies, even when they're just trying to raise cash to complete, brings us right into our next segment. Earnings reactions and the mid-cap movers.
It gets rough here.
Yeah, because if you want to see how strict and frankly how ruthless Wall Street is being right now, you just have to look at today's single stock stories.
Yeah.
Let's run through a few of the notable ones. Aramark, the food service and uniform giant, rallied nicely, up 8.5% on stronger than expected profit and revenue.
Solid quarter for them.
Cardinal Health added 1.3% on a solid profit beat, but then look at Rocket Lab, ticker symbol RKLB. They are an aerospace manufacturer and launch service provider.
Yep.
They fell over 4% today. Here's the kicker. Their revenue jumped 62% year over year, 62% growth.
That's huge.
But their quarterly losses were slightly wider than Wall Street analysts had modeled.
Ouch.
Similarly, Hims & Hers Health, ticker HIMS, tumbled 7% in the pre-market on wider than expected losses, even though their Q3 revenue expectations remain sky high.
Yeah.
And just glancing at the Morningstar top movers today to show you the extremes. On the positive side, NIQ Global was up a massive 41.8%, Alamar Biosciences up 30.4%, Septerna up 23%.
Big winners.
But the losers were equally brutal. Life360 down 25%, On Holding down 20.3%, Hub Group down 19.7%.
Oof.
So I want to focus entirely on Rocket Lab versus Aramark. This is where I struggle to understand the psychology of the trading desks.
It can be confusing, yeah.
Rocket Lab is launching rockets into space, securing massive contracts, and growing their top-line revenue by an astonishing 62% in a single year. And the market takes a 4% bite out of them just because they missed a profit estimate by a few pennies.
Right.
Meanwhile, Aramark, a company that provides cafeteria food and uniforms, grows modestly, hits their profit number, and jumps 8.5%. Why is the market so viciously unforgiving to high-growth tech companies right now?
It is vicious because we have fundamentally changed eras.
What do you mean?
We have transitioned from the ZRRP era to the 4.7% yield era, and the rules of physics for stock valuations have completely rewritten themselves. ZRRP stands for Zero Interest Rate Policy. For over a decade following the 2008 financial crisis, and especially during the pandemic, the cost of capital was essentially zero.
Right.
When money is free, investors are incredibly patient. They don't need profits today. They are perfectly happy to fund a company that burns cash for 10 years as long as that company is capturing market share and growing its top-line revenue.
Yeah, growth at all costs.
Exactly. In that era, a company like Rocket Lab growing revenue at 62% would have seen its stock surge 15% on earnings day, and nobody would have cared about the widening losses.
Because if money is free, the future is just as valuable as the present.
Exactly. But that era is dead.
Very dead.
Today, as we discussed, the 10-year Treasury yields nearly 4.7%. The cost of capital is exceptionally high. When an investor can get a guaranteed risk-free 4.7% yield today, their patience for unprofitable growth completely evaporates.
They want their money now.
They demand a clear, near-term path to actual free cash flow. If you are Rocket Lab and you are growing top-line revenue by 62%, but you are bleeding cash to do it, the market looks at your balance sheet and realizes that you might eventually have to borrow money at punitive interest rates.
Oh, man.
Or dilute your shareholders just to survive long enough to become profitable. The market is aggressively repricing that risk downward.
Wow.
Aramark, on the other hand, is a mature business generating immediate cash today. In a high-interest rate environment, $1 in the bank today is worth vastly more than 3 hypothetical dollars 5 years from now.
I want to make sure you, the listener, really internalize this because it explains so much of what we're seeing. It's not that Rocket Lab is a bad company or that 62% growth is somehow bad. It's that the macroeconomic gravity has gotten heavier.
That's a great way to put it.
If you can't show the market the money right now, they will drop your stock. And this unforgiving price action, this recent volatility we've seen tearing across the summer, the research we are looking at today suggests that it isn't just random chaos. It is actually following a very strict, very predictable historical script.
Yeah, the midterm script.
Let's look at the midterm cycle context. 2026 is a midterm election year. Historically, going all the way back to 1926, midterm years are notoriously difficult for equities.
They really are.
They average only 5.8% gains for the S&P 500 across the entire 12 months, which makes them by far the weakest of the four-year presidential cycle.
Yeah.
And more importantly, they feature an average intra-year drawdown, meaning a peak-to-trough drop during the year of roughly 16% due to congressional uncertainty and shifting policy expectations.
It's a bumpy ride.
It is. But here's where the data gets truly wild, and this connects directly to what you were just saying about the cost of capital. Margin debt hit a record $1.5 trillion in June of 2026.
Unbelievable number.
Let me repeat that. $1.5 trillion. That is 60% above the previous all-time record set back in the euphoria of 2021. And that sudden, violent summer tech sell-off we all just lived through a few weeks ago, the data is finally confirming what caused it.
Yeah, we finally know.
It was triggered by a massive margin call on a single, highly leveraged fund called Situational Awareness. They were levered 4-to-1 in AI infrastructure stocks. They got caught slightly offside on a trade. And they were forced to liquidate $45 billion in a matter of days, eventually falling to Citadel's hands to be unwound.
This is such a crucial piece of market history that we just lived through, and we really need to unpack exactly how it happened.
too.
This is where I'd like to introduce the quench analogy to explain systemic market leverage.
Okay, lay it on me.
Think about liquid helium. It is one of the most remarkably stable substances on Earth, kept at minus 269 degrees Celsius.
Super cold.
Very. In an MRI machine or a particle accelerator, liquid helium holds its form and cools the superconducting magnets under enormous constant pressure. It behaves perfectly. But if you push it just 1 degree past its critical threshold, or if there is a tiny leak in the vacuum seal, it doesn't just gradually warm up and melt like ice.
What does it do?
It violently boils and explodes into a gas, expanding 750 times its original volume in a matter of seconds.
Ooh.
Yeah. In physics, scientists call this catastrophic failure a quench. That is exactly what happened to the stock market this summer. The pressure build was at $1.5 trillion in margin debt.
Wait, so just so we are absolutely clear on the mechanics, margin debt is simply investors, or in this case, massive hedge funds, borrowing money from their prime brokers to buy more stock than they could afford with their own cash. Right?
Correct. It amplifies gains on the way up, but it dramatically amplifies losses on the way down.
Got it.
The market was holding that $1.5 trillion pressure steadily. It was stable, just like the liquid helium. But then that specific fund, Situational Awareness, hit its threshold.
Because they were levered 4-to-1.
Exactly. Being levered 4-to-1 means for every $1 of their own money, they borrowed $4. When the tech stocks dipped just a few percentage points, the value of their portfolio dropped below the minimum equity requirements set by the banks who lent them the money.
Oh.
The banks issue a margin call. They say, deposit more cash right now, or we will automatically sell your stocks to protect our loan.
And I'm guessing they didn't have the cash.
Situational Awareness didn't have the cash. So the banks forcefully liquidated $45 billion worth of tech stocks into the open market.
And when you dump $45 billion of NVIDIA and Microsoft and Supermicro onto the market all at once, there aren't enough buyers to absorb it.
No way.
The prices crash, which then triggers the margin calls for the next fund down the line and the next one. It expands 750 times its volume in seconds. It's a quench.
Exactly. It creates a mechanical, cascading avalanche of forced selling. But this raises an incredibly important question for the listener looking at their own portfolio. Was that terrifying summer sell-off a reflection of fundamentally bad businesses, or was it just bad leverage?
Well, considering everything we've talked about, I'm guessing leverage?
The data unequivocally shows it was leverage. While the stocks were crashing, Q2 revenue growth for the broader market actually hit 14.1%, which is the highest growth rate since 2021.
That's incredible.
Net profit margins for the S&P 500 hit record highs. The drop wasn't a verdict on the fundamentals. The companies were earning more money than ever.
Right.
It was a verdict on forced liquidations. It was a plumbing issue in the financial system.
That makes total sense.
And historically, this sets up a fascinating dynamic. The fourth quarter of midterm years is historically the strongest quarter of the entire four-year political cycle.
Really?
Yeah, it averages 7% gains in just 3 months, with an 88% positive hit rate dating back nearly a century.
Wow.
Once these margin calls happen, the forced liquidations clear out the weak hands, flush the toxic leverage out of the system, and reset valuations. It historically sets up a highly bullish, structurally sound end to the year.
I want to make sure you really hear this point. The businesses didn't fail this summer. The stocks crashed purely because a few funds borrowed too much money and the banks forced them to sell.
Right.
If you understand the difference between a business failing and a prime broker liquidating a leveraged fund, you understand why the market eventually recovers.
Absolutely.
Speaking of highly leveraged AI infrastructure plays and the market's ruthless demand for profitability, the entire market is bracing for two massive bellwether earnings reports crossing the wire right now, literally as we speak, after the closing bell.
Oh, yeah. Everyone is watching these.
First up, we have Supermicro, ticker SMCI. They manufacture the high-end servers that actually house NVIDIA's chips. They closed at $31.46 today.
Yep.
The street expects earnings per share of $96 and revenue of $11.56 billion. The options market is pricing in a massive plus or minus 13% to 16% move on this stock by tomorrow's close.
That is violent volatility expected.
It really is. Let's look at the two sides of the trade. The bull case for SMCI is intoxicating. They have a record backlog of over $60 billion in new orders from companies desperate to build data centers.
It's a huge backlog.
Because they have achieved immense scale, their gross margins are expected to leap to 15% to 17%, up significantly from their previous 8.2% to 8.4% range. You just look at that, it sounds like an unstoppable juggernaut.
It does.
But then you look at the bear case. Their operating cash flow was a negative $6.6 billion in Q3 and a staggering negative $7.56 billion over the trailing 12 months.
Brutal.
They only have about $1.3 billion in cash sitting on their balance sheet against $8.8 billion in debt. The huge question looming over the call tonight is, will they need to announce a highly dilutive equity raise, just like Intel, simply to buy the raw materials to build the servers they already have orders for?
That's the fear.
And right alongside them, we have CoreWeave, ticker CRWV. They are a specialized cloud provider renting out access to these AI GPUs. Close at $88.19 today. Expected revenue of $2.54 billion, which would be up an astonishing 111% year over year. Options are implying an even more massive 15.5% to 17.5% move tomorrow.
Even bigger move.
The bull case here is similar, a mind-boggling $99.4 billion backlog of locked-in future revenue.
Almost $100 billion.
Yeah. They just announced a major collaboration with Leidos for defense and intelligence workloads, locking in government money, and they are aggressively expanding data centers into Indonesia.
Right.
But the bear case is terrifying. Interest expenses are absolutely eating them alive. We are talking about $650 million to $730 million in interest payments expected just for this single quarter.
Just in one quarter.
Just in one quarter. They just recently closed a $2.6 billion debt facility priced at SOFR plus 5.5%.
Yeah, that's rough.
Let's pause right there, actually, because we need to define that jargon. For anyone not deeply entrenched in corporate credit markets, what exactly is SOFR plus 5.5%, and why is that bear case so alarming?
It is incredibly alarming. SOFR stands for the Secured Overnight Financing Rate.
Okay.
It is basically the foundational baseline interest rate that banks use to lend to each other. It moves closely with the Federal Reserve's benchmark rate. Currently, SOFR is sitting right around 5.3%.
Got it.
So when CoreWeave borrows $2.6 billion at SOFR plus 5.5%, you add those together. They are paying roughly 10.8% interest on billions of dollars of debt.
10.8%. That is bordering on credit card level interest rates for a corporate entity.
Exactly. And that is why these earnings reports are so critical. It perfectly illustrates what analysts are currently calling the funding gap. We have officially transitioned into a new, more mature phase of the AI trade. A year ago, Wall Street was easily hypnotized by top-line revenue growth or massive backlogs.
Right.
But today, they are no longer impressed by a backlog alone. They want to see how that massive capital expenditure actually converts to free cash flow.
So what does this all mean? I mean, what good does it do to have a $60 billion backlog at SMCI or a $99 billion backlog at CoreWeave if they are burning cash so fast they might literally go bankrupt trying to buy the concrete, the copper, and the chips to fulfill the orders?
That's the exact problem.
Does a $100 billion IOU matter if you can't survive to collect it?
That is the multi-billion-dollar question, and it is the existential risk of the entire AI infrastructure transition.
Right.
If you have a $99 billion backlog, that's an incredible display of market demand. But if you have to borrow money at 10.8% interest to physically build the data centers, to secure the power grids, to lay the fiber optics to fulfill those contracts, your cost of capital is astronomical.
Astronomical.
If your operating cash flow is deeply negative, As it is with both of these companies, you are essentially in a terrifying race against the clock.
Yeah.
Could you finish building the infrastructure, turn the servers on, and start collecting that backlog revenue from clients before the 10.8% interest payments completely crush your balance sheet and trigger a default?
It's a high-stakes race.
We saw the market violently punish Intel for equity dilution, but relying on high-interest debt carries its own fatal risks. Tonight's earnings calls for SMCI and CoreWeave won't just be cheerful updates about AI demand. They will be brutal, forensic interrogations by Wall Street analysts about liquidity, monthly cash burn, and the perilous mechanics of financing this massive technological leap.
Which perfectly sets the stage for what we will be watching tomorrow, because the data calendar is incredibly heavy. And every single release ties back to exactly what we just discussed regarding inflation and the cost of capital.
Oh yeah, it's a busy week.
Right at 8:30 a.m. Eastern tomorrow, the July Consumer Price Index, the CPI, drops. The headline inflation number is expected to ease down to 3.4% year over year, with the core inflation metric, which strips out volatile food and energy, cooling to 2.5%.
Right.
If those numbers come in hot because of the oil spike, watch the bond market react instantly.
It'll move fast.
Then on Thursday, we get the Producer Price Index, the PPI, following right behind it to give us the wholesale inflation picture. For earnings tomorrow, we will be watching Cisco, Lumentum, Coherent, and I highly recommend keeping a very close eye on Nebius, ticker NBIS, because of their deep structural connections to NVIDIA's supply chain. Then Applied Materials reports on Thursday.
There is a massive amount of data for the market to digest over the next 48 hours.
There really is.
But whether we're talking about small business labor shortages, the yield curve, or AI backlogs, it all fundamentally comes back to one core concept: how the market prices risk and the cost of capital in real time.
Exactly. And as we wrap up today's deep dive, I want to leave you with a final provocative thought to mull over as you watch the futures trade tonight.
Let's hear it.
We talked extensively about NVIDIA raising $500 billion from Wall Street banks to privately fund data centers. We talked about companies like CoreWeave carrying tens of billions in high-interest debt just to build out AI capacity, racing against their own cash burn. At what point does this global AI infrastructure build-out become so heavily leveraged, so capital-intensive, and so deeply intertwined with the balance sheets of the major Wall Street banks that it essentially becomes too big to fail for the broader financial system?
That's a scary thought.
If that AI engine stalls, or if the technology doesn't monetize as fast as the debt matures, it won't just be a red light for tech stocks. It could trigger a catastrophic pileup for the global credit markets.
Absolutely could.
Make sure you follow the show on whatever platform you use for your daily, fast-paced market coverage. We'll be back tomorrow to see if the light turns green or if the engine finally stalls.